covers retail at Roth Capital Partners. Bill, the call is getting a lot of attention, so we appreciate you coming on Power Lunch. What's the primary thesis behind that sell rating?
Yeah, thanks for having me. The primary thesis is when you unpack the quarter, there's a lot of key metrics that are going the incorrect way. If you take a look at traffic, whether it's in the United States or even the worldwide number, it's decelerating. It decelerated this quarter from last quarter, which decelerated from 2 quarters ago. If you look at renewal rates, the renewal rates are fading, and they've faded a few quarters in a row. And what really put us over the edge with this for the downgrade was if you take a look at their paid members. Their paid members grew 400,000 400,000 quarter over quarter. For years, it had been 1 million new paid members quarter over quarter. So you have a big deceleration of incremental paid members at Costco, and that's come despite them opening more clubs. So more clubs should bring more members. If you adjust for that, same store or same club paid members might not be growing anymore. And that's a big divergence for what people think about this stock and how valuation treats it.
It reminds me a little bit of the Chick-fil-A issue. I always have this rule, like as soon as one opens near me, it's over, and they finally have. And it feels like, the portions are smaller. They're not publicly traded, so we don't know about the comps. But with Costco, too, as they open more centers, is it possible that they lose the specialness that made them so unique and kind of drove so many people to want to go? And now it just becomes a little bit more commoditized. And as Brian has talked about a lot, you've got Walmart with a great digital product, great prices. Not everybody needs the bulk scale of Costco. So I wonder if they've kind of hit penetration.
Those new clubs, they increasingly cannibalize the existing clubs, right? When you have 900 plus stores, just logically you would think the 922nd store won't be as good of a real estate location as some of the first stores. So they're cannibalizing and competing with themselves more. Walmart, to Kelly, your and Brian's point, Walmart is competing with them more, both Walmart.com and Sam's Club. Sam's Club's getting increased openings, increased investment, increased tech, and even BJ's Wholesale is opening more stores. So their own stores, Costco's openings, competing with existing Costco, Walmart, and BJ's. And so you have increased competition against a wholesale segment that is maybe becoming a little bit more commoditized and just more like a traditional shop that you can get in most places.
Is Costco counter-cyclical? Bill, does it benefit if the economy goes down because people look for more savings? Or, to Steve Leisman's point, maybe at the top, does it benefit because it can be a fun store to shop at? And I know a lot of really well-off people who love going to Costco.
They do a fabulous job of offering very good value. So when people seek value, Costco comes to mind. And so they benefit when value seeking increases. They also over-index to that high-income consumer that Steve was talking about. So they over-index to that high-income consumer. And so if that consumer is feeling fine, they're shopping for discretionary stuff at Costco as well. So they kind of have both sides. And that, to Costco's credit, they have both sides. If people want value, go get your food at Costco. You'll find a lot of value. If the higher-income consumer is feeling good, go to Costco. You're going to find some good discretionary assortment, some unique assortment that other retailers don't have. So they kind of have both. So I wouldn't say it's anti-cyclical, but they are diversified from the cycles pretty well.